The start of December saw stock prices, particularly in tech, slide, spooked by a weaker than anticipated job growth, the Fed's decision to start buying bonds in the open market, and of course, the gates of hell that the new Omicron variant may end up opening. But interestingly, the start of December also saw a slide in prices of Bitcoin and Ether. Now, one of the charms or draws of investing in cryptocurrency is that price movements in cryptocurrencies are usually not correlated or thought to not be correlated to that of the stock market. But as Web3 is creating more bridges between crypto assets and the real economy, so that crypto tokens and currencies are of more use in the real economy, that correlation is fading, and it's fading real fast. Hello YouTube, I'm Rashad, and today we're talking about the differences between crypto assets and stocks. So put on your finest suit and tie, because we're taking this discussion to the investment board. But before you put on your finest attire, disclaimer, nothing that I say on this YouTube channel, or rather anybody says on any YouTube channel, should be taken as financial advice. There is no free lunch, and always do your own research. With that out of the way, let's do definitions. The shares that you and I can buy in, say, a company like Apple are units of ownership in the company. A company issues ownership shares to raise cash. You give a company your cash for them to do business with in exchange for a percentage of the ownership in the company, however small, through the shares that you buy. What are cryptocurrencies? Cryptocurrencies are native tokens of the blockchain network that powers the Web3 project. For example, Ethereum's native token is called Ether. Unlike stocks in a company, the native tokens or crypto assets tied to a crypto project represents not only ownership, a bit of ownership of the crypto project, but also a unit of functionality. You can use these native tokens to directly avail the services that are offered by a Web3 or a crypto project. So unlike your shares in Apple, you can use Ether to actually pay for things. You can use Ether to buy a GIF of a cat farting rainbows and hurtling through space for millions of dollars. But you can't even trade in your Apple shares for Apple products. You'd have to sell your Apple shares and then use that cash to buy your iPhone 13. And then a year later realize that all they did was just give you a minor upgrade on the camera, and the Apple shares that you could have held on to have appreciated so much more in value. You can stake certain cryptocurrencies to earn an interest that compounds over time to give you a juicy APY. The way that works is you commit to a time period, say days or weeks or months, where your crypto assets are locked up, and you keep receiving interest on the locked up crypto assets. Some stocks can give you something similar in dividend yields, but compared to the very high rates of return you get when you're staking cryptocurrencies, the single-digit dividend yields from stocks are easily eclipsed. But for all the rigidity of stocks, the stock market is regulated to protect you, the investor. It takes a lot of work for a company to list its shares on a public exchange. Large investment banks have hundreds of employees do copious amounts of research, do roadshows around the world, and run models to determine the price at which to IPO the share. That is, the price at which to present the share for the very first time when it's listed on a public stock exchange. A company's stock price is directly correlated to how well the underlying business is performing by selling goods and services of the business. That's all fine and dandy. If the world of stocks is a business attire event, the world of cryptocurrencies is a shoes off, shirts off mud fight. There is no regulation. Anybody could create a cryptocurrency with no underlying Web3 application. There is no equivalent to the IPO process. So if you bought Squidcoin, I'm sorry, your money's gone and there's nobody you can sue. One of the ways in which you can establish confidence in a company is when you see reputed investment firms buy shares of that company and share the positions they own on these companies on their portfolio. With cryptocurrencies, there's no way to tell who owns anything. All you see on the blockchain for who's trading what are obscure hashes for identities. A great win for privacy, not so much for investment research. So while investments in cryptocurrencies can bring you much higher returns, the risks are proportionately also higher. You can make more informed decisions when you're making investments in stock because you just have more to research on. So whether or not you're thinking of investing in cryptocurrencies, if you'd like to stay informed about this space, hit that subscribe button, and I'll see you in the next video. Peace.